Well, it's now 3.75 years since the new approach was put in place and we took over running the trust in April 2017. And over that period, we've seen very strong absolute returns from the trust. The equity portfolios produced a return of 41.4% over that period. And over the calendar year of 2020, that was a return of 9.4%. On relative basis, we've performed roughly in line with the MSCI All Country World Index over the full period, which is actually something we're pretty proud of, given that it's been an unusual situation where the index returns have been driven by a very small number of very large technology stocks in the US in particular. And actually the vast majority of stocks have had much worse returns than the index. So given that backdrop, very pleased to have kept pace with the index. Yeah, so the idea mainly behind the trust is to ensure that stock selection is driving everything. So we try and ensure that we're not taking any significant style biases, big geographical exposures different to the index, or big bets on sector allocations, for example. And so we will move around the allocation between the managers just to ensure that it's that stock selection that continues to come through. So over the course of 2020, there were a few changes to the managers. We increased the exposure to some of the more growth-oriented managers and reduced the exposure to some of the more value-oriented managers early in 2020, which was particularly beneficial. So we start with a general principle of being on average 10% geared. And then if we're negative on markets, we'll be below that. If we're positive on markets, we can go a little bit above that. Coming into 2020, we were cautious on markets. We were at the lower end of that range. We were at 7 or 8% gearing. Following the falls in the first quarter, we then increased the gearing level slightly above 10% and then let that reduce as the recovery started. We've actually back to that 10% level following all the stimulus that's come from governments around the world and a fairly neutral view on equity markets from here.
We think that this is one key theme that will have a meaningful impact for many years to come. In terms of the shorter term period, there's been a real clear increase in how much weight market participants are placing on the progress of companies towards their sustainability goals. And the price performance that we've seen between new economy and old economy stocks has been really quite stark in 2020. There's clearly many other factors at play in such a year as well, but we see a lot from our stock pickers and from underlying companies on the importance of these factors. And the trust portfolio is really well placed through the attention that the stock pickers are paying to these areas. And that's reflected in the portfolio having 30% lower exposure to carbon emissions than the market overall. And also the relationship that the trust has with Federated Hermes for engaging with underlying companies to drive forward best practice and improve shareholder returns is vital. Now, there are several great examples of the benefits that this engagement can bring, but one that I particularly like is the engagement with Thailand Semiconductor, the manufacturing corporation, TSMC, on their approach to water stewardship. The manufacturing process for semiconductors is quite a significant user of water, and due to climate change, we all need to be more thoughtful about usage. But on such a scale, engagement was really vital, and Federated Hermes led that, and the company's made huge steps forward. The company now has a best-in-class water stewardship policy in place. It's recycling almost all of its water, and that's led to significant corporate cost savings of some $50 million per annum. So real clear, tangible benefits from an engagement.
So every equity manager will have a fairly standard answer for why holdings in the portfolio changed. Usually it's to do with either companies performed very well, they reached an intrinsic value target that you had and were sold from the portfolio. Or maybe something went wrong, it was a mistake and they moved on. Or maybe nothing dramatic really happened, but they just found a better idea for use of capital in their portfolio. So these three things, they hold true for Alliance Trust as well. We have examples of all of those, like most managers do. The thing that makes Alliance Trust really different from most global equity products that you'll look at is that we use only concentrated portfolios. We ask managers to focus just on their 10 to 20 best ideas. These concentrated portfolios bring a high degree of competition for capital. Managers are not able to leave a stock in the portfolio languishing in the tail whilst they think about reviewing it later or just leaving it some time to decide what to do with the company. They're forced to always think about which are the best ideas and how do they allocate capital in the portfolio. And particularly in a year like 2020, where we saw a high degree of volatility, both with market declines and very strong rallies and factor rotations, that desire for managers to constantly reassess their portfolio and allocate capital where their best and highest conviction ideas are is a real benefit to Alliance Trust. The Alliance Trust portfolio is driven by stock selection. So I don't expect to own all of the largest or most prominent stocks in the portfolio at the same time. We do own some of them, of course. So we've got big positions in companies like Amazon, Facebook, Google, or even Microsoft, but we don't own Apple and Tesla. And that's really a result of the managers just doing what they're supposed to be doing, which is being very selective about stock selection. Of course, when we look back at 2020, it's easy to point out that Apple and Tesla did very well. But when managers are making stock selection decisions on your behalf, they have to make a forward-looking view, and we only want them to risk capital when they've got a very high conviction view, not only in the company that they want to buy, but they've got a very differentiated view versus the market and a different view of what the market is expecting. We think this stock selection approach is going to drive long-term success for Alliance Trust. And we do think the managers are going to find interesting ideas all across the market spectrum. And we certainly don't want them to own companies simply because they're large or big parts of the index.
So after the turbulence we've had of 2020 and despite the current economic uncertainty that results from continued lockdowns across a large proportion of the globe, the positive news is that we've all seen in respect to vaccines and the reduced uncertainty following the US election result and the Georgia Senate runoffs. They all contribute to what we see as a much more constructive picture for markets in the coming years, albeit one where we see risk levels remaining high overall. Valuations are undoubtedly high versus history, particularly in the US. But with interest rates at historic lows and likely to stay there for some time, as well as the continued monetary and fiscal stimulus that we are expecting to see strong economic recovery into 2021. That's in part been priced in by markets in recent months, but we do see still a very broad divergence in valuation across markets and companies that will present opportunities for skilled stock pickers.
Our managers run concentrated portfolios of their best ideas, and we generally think all of their stocks are really exciting. But we picked out a few stocks which those managers think are really compelling when looking forward for the next 3 to 5 years. One of our deep value managers owns XPO Logistics. XPO is a logistics company focused on small-sized last-mile delivery services. This is a fast-growing area of the market, growing significantly faster than GDP. Consumers are increasingly demanding more flexible, more reliable and faster delivery services. This is driving complexity. XPO has been investing heavily in the business and in technology to meet this demand and has built itself significant competitive advantages. It's now one of the biggest e-commerce fulfillment businesses in the world. Despite the success of the company, the manager believes it's still significantly undervalued and also undervalued on some of the parts basis. The manager believes there's significant opportunities to unlock value in this business and drive long-term success. Another of our managers that focuses on high-quality companies trading at a discount owns TransDigm Group. Now, TransDigm makes highly engineered products that are niche components in the aerospace industry. It is a long-duration, high cash-flow business. Of course, the aerospace industry has been going through a torrid time recently, but TransDigm is a good quality company. More than 90% of its products are proprietary, more than 80% of its products are ones where TransDigm is the only supplier of that product. And more than 85% of its EBITDA comes from aftermarket sales rather than OEM business. This is a good, durable business in an industry that has gone through significant restructuring and transformation. Overall, we think as a long-term investor, the crisis of last year has enabled us to buy this good quality company at a significantly discounted price. And even though it has recovered somewhat, the manager still believes the company is trading on a discount to its intrinsic value of more than 50%. Being a long-term investor, we think this is a great opportunity to take advantage of volatility to drive long-term success. The simple answer is no. We don't think Brexit is going to be a significant impediment to achieving our performance targets in the long run. Residents of the UK will be painfully aware that the discussion on Brexit has been going on for over 4 years now. And let's just say it's been a confusing time, to say the least, over the last few years. But the issues affecting companies are reasonably well known. Of course, it's just the outcomes that are unknown. But managers are able to model different scenarios and think about what those scenarios will do to the valuation of the company in the long run. Our investments in UK companies in the Alliance Trust portfolio are not a bet or a forecast on the outcome of Brexit. They're very company specific. And we do own some companies that are more UK domestically focused. For example, Lloyds Bank, where the manager believes that the market is overly pessimistic about the company, partly because of Brexit, but for other reasons also. And he thinks the recovery potential of the business is a lot stronger than the market is currently pricing. Overwhelmingly, however, our exposure to UK companies is really global multinational businesses that happen to be listed here in the UK. So these companies include things like DS Smith, a global sustainable packaging solutions provider or recycling service provider worldwide. Also Convatec is a medical products business focusing on therapies for chronic conditions. Or you've got engineering businesses like Weir Group, focusing on more efficient and sustainable solutions for heavy industries. These are very different businesses in different industries operating in a global network. We don't think that Brexit is going to be a significant impact or impediment to these businesses performing very strongly over the long run.
So one of the biggest thematic trends is clearly sustainability, and there are clear impacts on how market participants are assessing the likely progress of underlying companies towards their sustainable goals. And having a full grasp of those risks and opportunities that a transition to a more sustainable world will present is going to be absolutely vital for successful stock selection in the coming years. So we've been spending even more time with our stock pickers discussing these issues, and we really feel that they're very well placed to do just that. The opening up of China to foreign capital is another real key theme over the coming years. The second largest economy in the world, and yet only a really small representation in global indices. It's an economy and a market that will present opportunities, so we need to be on top of that. And the stock pickers also need to be really closely monitoring the opportunities and the risks that these companies are presenting in their own right, as well as to competitor companies that are in the global opportunity set that they have. And finally, the spread of valuations between companies in different industries is at all-time extremes, particularly between growth companies and more traditional value companies. The divergence has never been wider. So any single style manager is particularly exposed to this, and that's a situation that further increases our conviction in the multi-manager approach with a broad spread of styles so that our shareholders are less exposed to that risk.